Okay, so welcome to video number 6. What we're going to be doing here now is moving on from historical volatility to future volatility, so forward-looking volatility, sometimes called implied volatility. Now, this is a big topic, so we've decided to split this into 2 videos. So in video number 7, Chris is actually going to show you how to calculate your own implied forward-looking volatility. And in this video, I'm going to introduce you to a lot of concepts and understanding behind implied volatility that is very important for your skill sets, not just as a retail trader, but also for pro traders. So let's crack on. Market volatility. Well, so far, what have we done? We've realized so far historical volatility by calculating distribution of returns and average true range percentage. And we've done this for multiple market instruments. And by doing it, we've come to obviously a number of conclusions and acquired a whole bunch of tools to help us assess both opportunity and risk. So utilizing historical volatility in order to gauge the future expected returns of assets over assumed time horizons. Now what we're going to do, we're going to look at future volatility, implied volatility, so expected volatility in the future as priced right now by the market. Now, it stands to reason that historical volatility, as you've seen when we downloaded all of the past data for asset prices in order to analyze historical vol, it stands to reason that historical volatility is just factual. It's data. It happened in the past and it can't change. Implied volatility, however, is the volatility that's expected, that's priced in, given all the current market information now of what is to occur in the future, and it can actually fluctuate. And that's very important to understand, because implied volatility, because it can change, because it can fluctuate, it's changing because expectations of the future are always dynamically changing in the market. Now, obviously, Chris later is going to show you the ways of calculating implied volatility, so you can use that yourself forever in the future. That's the mechanical side of things. What we want to help you understand here, by introducing you to a few things and few ideas and concepts, what we want to help you with here is to have a broader understanding and idea of what volatility means and what it can do before we show you the mechanical side of volatility. It's very important for retail traders and professional traders to understand this, because it's very easy, when you're in trading and you're crunching data a lot, to get lost in the data and not think of the bigger picture and understand what all this really means. Looking at the bigger picture, one of the most important things you're ever going to do as a professional trader, not least a retail trader, is to assess the overall market volatility. What does that mean? Well, it's the overall market expectation of future volatility. So implied market volatility. And market volatility has implications that retail traders on the whole don't fully comprehend. What we're going to discuss here is why market volatility is so important to both a professional trading strategy and a professional trader's risk management. And obviously, as a retail trader, you can take this information, understand the bigger picture, and apply it to your own processes and risk management. So what do we look at when we look at market volatility? Well, in the United States, it's obviously the S&P 500. And what we're looking at is the VIX, the VIX, the VIX. It's the CBOE Volatility Index, the S&P 500 CBOE Volatility Index. And here on the screen, we've got the VIX charted from 1997 to 2020. And you can see, there's troughs, there's peaks, there's big moves historically. You can see that there's long periods where the VIX stays lower, and then small periods where the VIX goes a lot higher. And yes, you've guessed it right. The lower periods are generally associated with stable markets, and the higher levels are generally associated with uncertain and volatile markets. So let's try and understand this in the bigger picture. What is the S&P 500 VIX? Well, the VIX is a measure of the implied volatility of the S&P 500 index options. So we've got, on a weighted basis, the S&P 500 and the options on the index of the weighted index. So it's a quoted percentage, and it's the expected movement in the S&P 500 index over the upcoming 30-day period, which is then annualized. And it's dynamic. It's calculated all in real time. So, for example, if, say, the VIX is 15, this basically represents an expected annualized change of 15% over the next 30 days. So annualized, but over the next 30 days. So we infer that the index option market expects that the S&P 500 will move up or down by 15 over the square root of 12, which gives us 4.33%. So we're expecting from a level that's annualized at 15 over the next 30 days, we're expecting that the S&P 500 will move up or down 4.33% over the next 30-day period. Now, don't worry too much about the calculations and how they work at the moment. Chris is obviously going to show you how all this works in the next video with the spreadsheet calculation exercises. But let's just take for granted that the numbers are right here and move on to try and understand the bigger picture here in this video. Now, index options are priced with the assumption of a 68% likelihood, so that's one standard deviation, as you must now recall from previous videos, so the distribution of returns video. So index options, they're priced with the assumption of a one standard deviation, 68% likelihood, that the magnitude of the change in the S&P 500 in the next 30 days, so that 4.33%, that will be the move up or down, okay? That's important to remember, both up and down. So remember, it's both risk and opportunity. And, how has this worked out? Well, the prices of call and put options are used to calculate the implied volatility because volatility is one of those factors used to calculate the value of the options. How does it work? Well, higher volatility of the underlying security makes an option more valuable, and lower volatility of the underlying security makes an option less valuable. Why? Because, well, a higher option price implies greater volatility, all things being equal. And that's because if there's more volatility, then it means there's a greater probability that the option will expire in the money. So the option is more valuable. And obviously, vice versa is true as well. If there's lower volatility expected, then the probability that the option will expire in the money is lower. So the option will be priced lower. So assuming all other inputs remain equal, a greater volatility implies higher option prices. And vice versa, higher option prices imply there must be greater volatility. So why is this important? Well, The VIX is important because for traders and portfolio managers, they have live positions in the market. They are running portfolios, they're running positions with different strategies, and the bigger picture market environment is important, especially for risk management. It's often stated that, and I quote, "Volatility is a trader's best friend and a portfolio manager's worst enemy." So, for example, if there's an expectation that there's going to be more volatility in the market in the future, then this potentially creates more short-term trading opportunities in the market. And if there's an expectation that there's going to be less volatility in the market, then this creates less short-term trading opportunities in the market. So traders are therefore slaves to volatility. If there is no volatility, there are no opportunities or risk in the market. Now, professional traders are totally aware of this fact, and we don't seek to profit or try to profit on short-term positioning when volatility is expected to be low. We remain long-short portfolio managers with a 1 to 3 month time horizon on all of our positions in our portfolios. Now, when volatility increases by a big percentage move in a short space of time, well, this just means that the expectations of future volatility in the market have aggressively shifted. And what professional traders tend to do in this scenario is switch from being portfolio managers to shorter-term opportunistic traders. Now, let's try to understand this in a bit more detail, because this is going to be extremely useful for you going forward. If you recall when we did our daily distribution of returns analysis, so this is the historical realized analysis for distribution of returns that we looked at earlier in the video series for the S&P 500. When we looked at that, we realized that one standard deviation for the S&P 500 is 79% of cases, 79% of days. And that differs to a normal distribution of 68%. So we know when we look at a normal distribution that one standard deviation is 68% of times. But when we look at S&P 500 daily data historically, we know that one standard deviation occurs 79% of times. And if you recall, that's because the daily historical data of the S&P 500 is not normally distributed. It's peakier with fatter tails. Now, using this historical data as evidence, it means that basically professional traders, we must seek to be portfolio managers around 80% of the time and be short-term, so over, say, a one-day period or a one-week period, shorter-term traders no more than a maximum of 20% of the time. Now, introducing you to a concept here, because obviously this is dynamic. It changes all the time. It can fluctuate. When we're looking forward and we're looking at the VIX, we're looking at implied volatility. The VIX can move. Okay, so when S&P 500 index volatility, the VIX is moving, we say that it's in transition. So when it's in transition and it's rising, what are we likely to do as portfolio managers, traders? Well, what we're likely to do as pros when the S&P 500 index volatility, VIX, is in transition and rising, what we're likely to do is we're going to be switching from being portfolio managers and seek to take advantage of short-term, so daily and weekly opportunities. And then the reverse is true as well. When the VIX is in transition and falling, we're switching from being short-term, so day and week traders, and seeking to build portfolios, long-short portfolios, and becoming portfolio managers with a 1 to 3 month time horizon. So based on the hard evidence, the historical hard data, we know that we should probably be around 80% of the time portfolio managers, and a maximum 20% of the time much shorter term traders. We know that from the historical evidence. But when we take this in combination with the VIX, because the VIX is live, it's dynamic, it's moving, it can fluctuate as expectations of future volatility change, we can use that as an indicator to understand whether we should remain portfolio managers, or we should be transitioning to shorter term trading, or we should be transitioning from shorter term trading to become long short portfolio managers. And the mix is 80-20 as evidenced by history. So, all you Pareto lovers out there, Pareto lovers of the natural order, yes, the 80-20 rule applies in financial markets. And this is one of the main reasons why retail traders tend to always lose money, because they perceive that professional traders are always seeking to gain from quick, short-term opportunities in the market. Unfortunately, you should be realizing this by now, by this stage in the video series, because we've been through multiple analyses of volatility. Unfortunately, that's just totally wrong. All professional traders in reality are first and foremost portfolio managers, and we're traders second. And as we've seen in earlier videos in the video series, this general perception from retail traders is just down to misinformation from market participants that have an inherent conflict of interest. So brokers and charlatan trading educators. What they're doing is they're selling you an idea or a narrative to create a perception to make you trade and for them to sell products to you. They're not presenting you with the cold hard facts like we have in this video series. And more importantly, providing you with tools and education so you can actually fact gather yourself and make your own assessment. What's happening here, guys, is they're just keeping you unconsciously incompetent, keeping you ignorant. And ignorance keeps the wheel spinning and keeps them in business. So our interpretation of the VIX, given that it's a measure of both risk and opportunity, it shows us, historical data and the VIX in combination, shows us that we should be portfolio managers in the vast majority of times throughout history, and we should expect to be portfolio managers throughout a long period or the vast majority of the future, but we need to be flexible enough. If we interpret the VIX properly, it means we have to be flexible enough that when expectations shift, that we do something about it. We manage our risk. We understand that when the VIX moves, we have to do something about it. We have to be active. Now, if volatility is a trader's best friend, why is it a portfolio manager's worst enemy? Well, let's run through an example here. So let's think about it from a theoretical level. And this does happen in practice as well, but obviously people's portfolios in practice are a lot more complicated. But let's try and understand the bigger picture and the concept here. If we take a $100,000 gross exposure portfolio, and let's assume that it's quite well diversified and it's a cash for cash portfolio. So the longs add up to $50,000 of exposure, and the shorts add up to $50,000 of exposure. And we've got 10 positions. So let's say we have 10% position sizes, or each position is going to be $10,000. Now, on a $100,000 gross exposure long-short portfolio, let's say it's made up and it's fairly representative of the S&P 500 volatility. So let's say it's made up of S&P 500 mega cap and large cap stocks. What's going to be the volatility of the P&L on a normal day? So on a normal day, we're talking within the bounds of one standard deviation. So we know from our distribution of returns analysis that a normal day is 79% of times. Well, that just means that 79% of times on a normal day, the volatility of the P&L of that portfolio is likely to be roughly, it's not going to be completely accurate, roughly 0.35%, so around $350. Now, what would happen if everything else remained the same and the expected volatility in the market, so implied volatility, the VIX, goes up from 15 to 30? Well, it means it's doubled. So 15% to 30% annualized. It's doubled. Let's say it's done that very quickly. Well, what happens? Well, the portfolio manager hasn't even done anything. Literally everything else remains the same, but market volatility has doubled. Expected future volatility goes up. What happens? Well, the magnitude of the P&L swings per day, each day, will double from $350 to $700, roughly speaking. Now, that just means that the portfolio manager is taking more risk without actually doing anything. And this is why volatility is a portfolio manager's worst enemy. So think about this with all the big players in the market. What do you think happens at the top institutions like, say, a Goldman Sachs or an active hedge fund manager that's managing billions of dollars? When they forecast, when they think that implied volatility is going to go up by 100% in the next few months, what are they going to do? Well, they're forecasting that they're going to need to be in transition. So what they will be doing is they'll usually buy some hedges, so maybe some puts if they're very long, and they're going to, at the same time, reduce their equities exposure by around 50%, and they're going to transition from being portfolio managers to becoming more short-term opportunistic traders. So from both an opportunity and risk management perspective, our time horizon becomes shorter, so that's the opportunity, and our position sizing becomes smaller because we have to control our risk. And as we've mentioned in the video series previously a number of times, risk and opportunity are two sides of the same coin. We have to take risk in order to get the opportunity. However, we've got to be active. We've got to be willing to react and do the right thing when situations occur that are out of our control and they dictate to us the approach that we as traders and portfolio managers have to take. In risk management of our portfolios, we've got to prepare for all eventualities. So we have to put preemptive risk management practices in place, and we've also got to be prepared to engage in reactive risk management practices so we can stand the best chance at long-term consistent profitability. Now, risk management practices, what you actually do in terms of designing your portfolios, how your portfolios should look, and also how you should react, etc. This is well beyond the scope of the IPLT video series. If you really want to do the work on that, you've got to progress further up the competency hierarchy by taking the PTM video series, where we go into a lot of detail on that. In the IPLT video series, we're introducing you to the concepts and practices of the way professional traders approach financial markets, so you can understand this properly and begin to emulate and climb from the bottom of the competency hierarchy to the next level. So when we think about this and think about the work and understanding that we've done on volatility so far, on market volatility, if you think about this in the context of our time horizon spectrum that we introduced you to earlier, what we're essentially doing here is we are operating in the 20 to 60 day time horizon for 80% of the time as a minimum, and sliding to shorter term trading down the time horizon towards the 1 day to 1 week time horizon, somewhere around there, a maximum of 20% of times. That's roughly what we should be doing, and our understanding of financial markets should dictate to us what our understanding is of our portfolio management approach. And this all should be starting to come together now, because we've looked at now 3 indicators. Obviously, Chris is going to show you how to calculate implied volatility in the next video, but we've looked at 3 measures, indicators of volatility, 2 historical, and in this video and the next video, 1 implied, so future volatility. We understand that future expectations of volatility can change. Therefore, we understand going forward that we have to be able to be flexible enough to slide out of the 20 to 60 day time horizon spectrum down to a shorter term time horizon when volatility is in transition going up, and then slide back from the shorter term to the 20 to 60 day time horizon when volatility is in transition and going down. This is how it works. Now, don't forget, and to put this into context, we obviously still have to have our systematic process in order to generate ideas, get the timing right, get the trade structures right, and then have preemptive risk management and reactive risk management when we're putting positions on. So, as you know, trade idea generation process, that comes from quantitative and qualitative fundamental processing to identify potential positions. Then a trade idea only becomes a trade idea when the timing is right for the volatility, the trade structure is right, and it fits nicely into our portfolio, and we have a risk management plan. So remember, it's not just about taking any position, any random position, and just throwing it in the portfolio. You still have to have a real process behind it, how you identify these positions. And obviously you can get that in other video series at ITPM. But for now, in the IPLT, we're obviously concentrating on the professional trader approach to financial markets to help you start to climb that competency hierarchy. And I'm going to introduce you to something now within implied volatility that is going to help you a lot in the future when you're trading the financial markets and building portfolios. It's going to help you a lot. It's going to save you a ton of money over your lifetime. It can actually make you a ton of money over your lifetime as well. If you understand this properly, it's extremely useful. Obviously, Chris is going to help you with implied volatility calculations soon in the next video. But let's understand some bigger picture stuff here when it comes to implied volatility, and understand how professional traders use the market implied volatility to manage portfolio risk. Obviously, volatility, whether it's historical or implied, is a measure of both opportunity and risk. But how do professional traders actually use this to manage portfolio risk? Well, from our theoretical portfolio earlier, the $100,000 portfolio, we noted that if the VIX rose from, say, 15 to 30, that it's actually doubled. And the trader hasn't done anything. That means the trader's risk has gone up. Without the trader doing anything, it's out of their control. And they have to react to that. And in the real world, they do. And this is all back of the envelope stuff. You know, there's no exact accurate answer here. But when you see the VIX going up by around 25%, it means that the portfolio risk of the entire world has just gone up by 25%. If it drops by 25%, it means the portfolio risk of the entire world has just gone down by 25%. Think about it. These portfolios are not just retail traders' portfolios. Retail traders are a very low percentage of the market. It's also the portfolios of big hedge funds, pension funds, mutual funds, and also the inventory that investment banks are holding. And, you know, this is why when you see the VIX move in a big way, you see the market move in a big way, both up and down, because market participants are de-risking. It's pretty obvious what we should be trying to do here. If this is the case, we should be aiming to de-risk before them. Now, believe it or not, the vast majority of market participants, even professionals, are actually very slow to de-risk. They tend to only do it when they're forced to take action. And, you know, obviously every institution has slightly different approaches, but it's all very similar. And believe it or not, they're actually slow to do it. When you think of the size of a lot of these organizations, a lot of the time when the VIX moves, these guys are sitting in committee meetings deciding what to do with their portfolios. And it can take them a long time to decide what to do unless they have a very, very flat management structure and they're very quick to move. Some of these guys are actually very, very sophisticated, but most are actually not. They're very, very slow. They bang heads, at different levels of management. They sit in committee meetings, and sometimes it can take them weeks to decide what to do. If they decide in days, that's a good outcome. If they decide in weeks, that's a bad outcome because the VIX can move very, very quickly when expectations shift. Now, what this does is it creates short-term trading opportunities for us. But to do that, we have to have cash or margin available to take advantage of the opportunities. And this is exactly why we look to transition first and get ahead of the game. The way you should think about this is almost like a traffic light system. So if you think of a traffic light, red, amber, green, think of a traffic light system and, let's call it the volatility traffic light system. So let's say the traffic light system is on red. It basically means volatility is falling, okay? What are we likely to do? We're likely to become more of a portfolio manager. When volatility is in transition, we can think of that as the amber stage, okay? So let's say volatility is actually in a transition zone where it's now going higher, okay? What's going to happen? Well, we're going to end up getting a green signal. So let's say it goes up by 25% or more. Roughly speaking, that is the shorter term trading zone, the day trading or the 1 week zone, because risk has gone up 25% across the board. And we know these guys are going to react. We know they're going to start de-risking. Okay. And when we go back into the amber zone, where volatility is falling 25%, we go back into the transition zone and we become, when it goes back onto red, a portfolio manager. Now, of course, there's things that we can do, but these are just kind of like best practices. We can do a multitude of things, okay? These are just kind of best practices. They're not rules, okay? You can do a lot of other things as well. But, if you think about these things and they're in your mind when you see volatility move, you're probably going to react. You're probably going to do something positive. This is called staying in motion, making sure that you're not the rabbit in the headlights or the rabbit in the traffic lights, as it were. So let's look at this. So when index volatility is in transition and rising, we should probably think about taking some steps. What type of steps can we take? Well, we can obviously reduce our risk. We reduce the amount of positions in the portfolio by, say, around half. So let's say you've got 10 positions, you might reduce it to 5. We obviously raise some margin when we do that in order to take advantage of shorter term opportunities. You could also reduce all of your positions by 50%, or you could also, when you reduce the amount of positions, reduce the remaining position sizes by another 25-50%. And then we can take a short-term trading approach, look for those opportunities, and take directional bets over a 1 to 5 day time horizon. Now, what happens when we get the reverse? When volatility is actually falling by, say, 25% or more? Well, we're probably transitioning again. We're going from a shorter term outlook, shorter term trading, to more of a portfolio manager. What we're likely to be doing is starting to increase the amount of positions in our portfolios by up to 100%. So let's say we went from 10 positions down to 5, reduce those remaining position sizes as well by 25 to 50%, but then volatility started to turn and started to fall. What are we going to do after we've taken advantage of shorter term trading opportunities with the margin that we've got in our trading accounts? Well, we're likely to be increasing the amount of positions by, say, 100%. So we go from, say, 5 positions back up to 10, and we start picking the levels where we do this on a discretionary basis to increase the amount of positions and increase position sizing. We're obviously now going to take a more portfolio-based approach and look for opportunities to make money over the 1 to 3 month time horizon. So we don't have to have freely available margin to take advantage of shorter term opportunities while others are de-risking in the market. We can put that cash to work in a diversified long-short portfolio. Now, you've obviously heard me referring to reactive risk management a few times during the video series. Consequently, this is one example of it. But this isn't, reactive risk management based on one stock, based on whether it's a winner or a loser in your portfolio. This is at the portfolio level across the board. So it's not based on fundamentals. This is really based on risk management at the portfolio level, okay? So what you're doing here is just reducing positions and position sizes, so your exposure when vol is going up, and increasing the number of positions and position sizes and your exposure when vol is falling. And you're doing that indiscriminately. You're not looking at the individual stocks and thinking, okay, well, I really like this stock, so I'm going to keep it. I'm going to keep it the position size, the size that it was before market volatility went through the roof. It's all irrelevant because the dollars that you've got in that one position and in all positions in your portfolio, as we looked at earlier, the daily P&L moves have gone up significantly without you doing anything. Therefore, the risk has gone up without you doing anything. So you have to be in risk management and exposure reduction mode. You're forced into doing it. And, instead of being in a situation where you're the rabbit in the headlights, rabbit in the traffic lights, and you're in a situation where you do this too late, we're doing it quickly, and we're doing it in a way before everyone else does it, so we can raise margin and we can be in a position where we can actually take advantage of the shorter term opportunities. Because if we don't, we're not going to be able to take advantage of them, and we're going to be sitting ducks. We're going to get killed. Okay. So we're doing this indiscriminately, reducing the dollar exposures regardless of idiosyncratic fundamentals of each position. And we're increasing our exposures later on when we see volatility come down again, when we become more of a portfolio manager. We're increasing exposures based on the future fundamental outlook. Now, this type of general approach and, the suggested actions that you would take in a situation like this, the caveat here is that, these are not rules. We're not telling you to stick to a rule book here, okay? There's no hard and fast rules or hacks in trading. And there's no hard and fast rules or hacks that can tell you exactly what to do in your portfolio when the VIX goes up or down aggressively. This is just something that you have to think about and some example actions that you should probably think about taking. You might come up with other ways of doing things, okay? But things that you need to be thinking about that, I want to put in your mind that must be there. You must be thinking about and wary of when you see the VIX begin to move either aggressively up or aggressively down. The caveat is that you need to come up with your own way of doing things because everything is situational to the moment you're in, okay? There's no hard and fast rules or hacks that you can apply to every single market condition, okay? There's no driver's manual that you can buy. There's no rule book, okay? Do not become a rules-based monkey retail trader. It always leads to making lazy and uninformed bad decisions in trading. You have to be flexible. It's all based, situational based on what is going on in the market at the time. So you've got to be flexible. Do not stick to rules. Do not stick to dogma because they create losses, okay? Everyone's risk tolerance is different. Everyone's portfolios look different. Everyone's strategies are different. And portfolios are built differently, okay? Don't stick to this as a, I have to do the exact thing that Anton says every time. Okay, it's not a rule book. Just, I want it to pop into your head when the VIX moves that you should probably think about doing something. And then based on the situation at the time and your read on the market, you will come up with ways of doing things yourself. Okay, so these are just examples. So, when the VIX rises aggressively, you obviously have to interpret what's happening in the world and why it's going up fast. If you don't like the volatility, you don't like the risk, then of course you have to start reducing exposure. You can do that in so many different ways, okay? This is just one example of how you would do it that we've given you today. Consequently, on the other side of the fence, when the VIX falls aggressively, you have to interpret again what's happening in the world and why it's falling fast. If you're finding it hard to make money trading short term, you've got to take that as a sign, okay? So take those two things hand in hand. You see the VIX falling fast, and you're now beginning to find it difficult to make money short-term trading, okay? Take that as a sign. You've got to start sliding back up into the 20, 60-day time horizon and starting to build a well-diversified long-short portfolio. If you don't take this approach, then you're not maximizing your opportunities as a trader, and you're not taking the professional trader approach, which is why we keep saying, and we've literally proved it to you in the numbers, retail traders, the perception that pro traders are always short-term is completely incorrect. You're not maximizing opportunities. When volatility is low, if you're a day trader or a very short-term 1 week swing trader, and you're just sitting there trying to make money all the time short-term, you're not maximizing your opportunities. You need to slide up the scale. Vice versa. If you're a portfolio manager and you're in the 20 to 60-day time horizon and you see the VIX starting to rally hard, if you sit there and do nothing and you don't raise margin and you don't take advantage of short-term trading opportunities, and that's up to the maximum 20% of times, you are not maximizing your opportunities as a portfolio manager, as a trader, as a pro, okay? Now, from a retail trader perspective and the IPLT outlook and what we're trying to teach you here, this is how professional traders do things, okay? They are 80% of the time minimum portfolio managers, 20, 60-day time horizon, sliding down the scale when volatility increases, in transition, raising cash, become shorter term, opportunistic traders on a 1 day to 1 week basis. And then they slide back when the VIX falls, okay? In the IPLT video series, we're introducing to these concepts so they're firmly in your mind, so you understand how financial markets work, how professional traders do things, and how to emulate professional traders in your retail trading accounts. Now, you have to be very careful how you interpret the VIX, because a lot of people do misinterpret it. You'll hear in the media a lot that the VIX is often called the fear index. People often confuse that to mean that if the VIX goes up, that the market must go down. It's just not mathematically true, okay? But before we get onto that, the VIX is called the fear index really because portfolio managers fear that because implied volatility is going up, the P&L volatility of their portfolios will go up. So they're not fearing that the market must go down. They're fearing that there's going to be more volatility in their portfolio, profit and loss. That's what they fear the most, and that's why it's called the fear index, not that they fear that the market will go down. And mathematically, by definition, if the VIX goes up, the market can also go up, because the VIX is a measure of future volatility in either direction. It's not just a measure of volatility in one direction. So it doesn't automatically, mathematically mean that if the VIX goes up, that the market must go down. And if the VIX goes down, the market must go up. And additionally, it definitely doesn't mean that if the VIX goes up, that the market has to go down and it goes down by a certain amount. And vice versa. If the VIX goes down, the market therefore has to go up and it goes up by a certain amount. People really misinterpret this and think that there's some sort of strong correlation that they have to trade based on the direction of the VIX. What happens is that it leads to people thinking that the VIX itself is a hedge to their portfolios. And, people think to themselves, well, why not just buy a VIX product, a VIX ETF derivative product, or derivatives on derivatives, a VIX ETF option to hedge their stock and stock option portfolios? Well, Chris Quill has done a lot of work on this, and he can show you why you definitely should not take this approach. So if you go to the download section of this video, you'll see a PDF file that you can read in your own time. The PDF is a full explanation of why VIX derivatives are not suitable hedges to stock and stock option portfolios. And the conclusion generally is that the VIX derivative instruments that are available in the market are genuinely not good portfolio hedges over time. But let's conclude what we've learned here before we go over to the next video, where Chris is going to show you how to calculate implied volatility for yourself. Let's conclude on what we've learned here. So what is the VIX? It's a measure of S&P 500 market level volatility, and it tells us a number of things. It's a useful gauge also of what actions we should take in general as traders. So first and foremost, when we combine it with the distribution of returns analysis and other historical realized vol calculations, like average true range percentage, for example, it tells us that we should, in all probability, be portfolio managers with a 1 to 3 month time horizon, 80% minimum of the time, and day to weekly traders a maximum of 20% of the time throughout history, and therefore we should expect to be that going forward. Okay? What it also does, why it's also useful, is it can tell us what actions we can take. It implies what actions we can take. Okay? So when the VIX moves aggressively, both up and down, we can use it as portfolio managers and traders as an indicator for shifting our approach. So transitioning from portfolio managers to traders, and then back again from traders to portfolio managers. But that does come with caveats, guys. Everything is situational. And at that moment in time when we're witnessing it, we still have to interpret what's actually going on before we can take the required actions. Now, if you've downloaded the PDF, had to read through it, when you read through it, you're going to realize that the VIX itself and derivative instruments of the VIX that have been created by providers to synthetically replicate the VIX are actually not suitable trading instruments to offer hedges to portfolios. What we have to do, the action we take as traders, we must do it ourselves. We can't outsource this, okay? We've got to be reactive at the time, interpret the information that's available in the market at the time, and react. It's more beneficial to do it this way than to expose yourselves to synthetic hedges that don't really work. We trade the positions themselves, we reduce exposure, we increase exposure accordingly, or we buy options outright as hedges prior to the move or in the early stages of a VIX move. We recognize what's going on, and on a discretionary basis, we take action. Now, in the bigger picture, understanding the VIX properly to enable a more professional trading approach by retail is very crucial. And this is why, retail traders never really obtain a level of understanding that's required in this area to really understand the professional approach and the approach that they need to take to get and maintain consistent profitability. They just have massive drawdowns on concentrated bets and blow up all the time, okay? At ITPM, all of the institute traders understand what's going on, okay, when there's market moves like this, when there's moves in implied volatility like this, okay, because they understand what it is and what it means, okay? The institute traders understand this because they've just been educated properly. They know what to do when volatility moves, and they just do it, okay? And this is why, for example, when vol moves aggressively up and the market falls, long-short portfolio managers massively outperform on the way down. And if you remember, earlier on in the video series, we introduced you to the concept of alpha and absolute return, and the example of, say, over a business cycle, when the market goes up for 5 years, 6 years, 7 years, and then drops. Long-short portfolio managers are making money on the way down, while other people, long-only managers and retail traders, are generally long-only, and they get completely wiped out. They have massive drawdowns and get wiped out, okay? So they lose all of their performance in the period when the market goes up, and they don't know what to do when the market goes down. They're not reactive. They don't see the situation happening, and they don't do something about it. So this is what it's all about, guys. Long-short portfolio managers, if you choose the risk that you want to take on the way up, and that's a higher level of the market risk, so the VIX risk, okay? If you choose a higher level of risk in your portfolio on the way up, you will outperform the market on the way up. But if you're long short and the market falls because volatility goes through the roof, if you know what to do, you will outperform on the way down massively, okay? So, then we turn a corner. And when vol moves aggressively down and the market begins to bottom or rally, long-short portfolio managers will transition back, okay, and build portfolios where, again, they choose a higher level of risk than the market risk, and then again outperform on the way up. So this is, understanding financial markets from a retail perspective. This is kind of like 101 stuff for pro traders. But, to get you out of that level of unconscious incompetence, you've really got to understand how this works, okay? Now, I'm sure you can think of past experiences where the market's, gone up for a very long time and then fallen very quickly. We've had a couple of those over the last 15 years. It's been a wild ride. But, the guys that really understand this have not been caught out on the way down, and they've done the right thing on the way up and never lost sight of what it really means, okay? So try to understand it. Obviously, you can rewind the video whenever you want, go through it again, but try to understand these concepts and understand that implied volatility is very important. Future expected volatility is dynamic, and it can shift. Historical volatility is hard-coded data, and it cannot be changed, okay? What I'm trying to do here in this video is introduce you to the concept of being dynamic in your own portfolio by understanding that implied volatility is dynamic as well. And you can also, obviously, react and do things to make sure that you never blow up, okay? So, moving on to the next video, you'll see in the download section a big spreadsheet that Chris has put together called the Implied Volatility Calculator. Chris is now going to show you how to calculate implied volatility for yourself from all the publicly available options prices and other data. Now, although you can actually obviously go to many third-party data sites and get implied volatility numbers for specific instruments via their options prices, it's a useful exercise for you to know how to do this, so you can do this for yourself forever, okay? So why is it useful? Well, firstly, you can check if the implied volatility number that you see on a website is actually right. So it's a head check to make sure that you're doing the right thing, okay? And secondly, if you do have any ambition whatsoever to go into the professional side of trading, you're going to have to learn how to do this anyway. Either way, it's just very, very useful to know how to do it. So pay attention in video 7. Once you know how to do it, you can obviously do it yourself forever without having to rely on anyone else or a third party to do the work for you. And I'll see you when I come back in later parts of the video series.